Hello.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Welcome to my podcast. Hope you had a great Easter. I did. Now back to work. So finally, Paul admits that the private sector jobs, not doing well at all. But listen to this cut first.
We're bringing those prices down rapidly, lower prices, bigger paychecks. You're getting lower prices, bigger paychecks. We're getting inflation, we're crushing it. And you're getting much higher wages. I mean, the only thing that's really going up big, it's called the stock market and your 401ks.
Okay, so let's break it down. So, we're getting lower prices and bigger paychecks. Now, prices aren't going down. They're just rising more slowly than before. So, inflation is around 2.83%. That means prices are still climbing. There's no question about it, but they're not coming down. They're just climbing a little slower, that's all. Now, let's talk about the paychecks. What's going on with the paychecks? So the paychecks, the wages are rising about 3.5% year over year. Now that's slightly faster than inflation, meaning real wages are finally positive. That's good. But here's the bottom line. So yes, paychecks are growing. And we're all happy to hear that, that's for sure. But they're growing just a little faster than prices. But people don't feel richer because it's just a little bit more. So prices are still too high. So that's why people are complaining. But no, you got to give them credit. We are doing a little bit better. Now, crushing inflation. Inflation is not crushed at all. It's stabilized. It's down from 2022 peak at 9.1%. That's a hell of a job getting it down from 9.1%. But still running around 3%. Now, that's above the Fed's 2% target. So they're having a hell of a time with inflation, and it's getting worse. And that's why the bond market, the yields are up. Because the people who are in the bond market want higher yields. Why? They want to be paid for the inflation risk. So inflation is not being crushed at all. So that's not where we are with inflation. Now, 401ks. Now, Fidelity reports the average 401k balance is up about 11%. Now, that's year over year. Now, Vanguard reports 13% year over year. So the average 401k balance across all ages is about $146,000. So bottom line, 401ks are up because the market had a strong year, not because the economy's booming. You know, we're not getting this magical economy. It's just because, it's not because people all of a sudden got richer. It's just a very small sector of the stock market boomed, and that brought everything up. But the bad news with 401ks, when we do get hit with inflation or stagflation, worse, and we do get taken down, you're not allowed to short your 401k. So generally, most people with 401ks never get out at the peak. They never retire when everything's right at the peak. It's usually after a crash or a large correction. And the problem with a 401k, when you're all said and done, you really don't get a great return because you can't short. I mean, when the market's going down, if you don't have the ability to short, that's terrible. At least with the spiders, you're better off because you can go long, but then when the market starts to correct or crash, you can then short the market. Now, I know you don't get that match, but that match is really a joke. They could not sell a 401k until they put that match in. That's what did it. But the match at the end of the day you really don't benefit that much from it. Because again, the problem is you get these 401ks going up, markets going up, and then eventually when the market corrects, you lose it. You give it back. If only they would allow you to short that 401k, what a different product that would be. It's a terrible product. It doesn't really work well, and it's really a failed product. And I'm not saying that. The person who put the 401k together years and years ago, it's his deal. He even says today he made a big mistake. It's just not a good product. So next time you hear this cut, play it again.
We're bringing those prices down rapidly, lower prices, bigger paychecks. You're getting lower prices, bigger paychecks. We're getting inflation, we're crushing it. And you're getting much higher wages. I mean, the only thing that's really going up big, it's called the stock market and your 401ks.
And that's because of a handful of stocks. But next time you hear that, now you'll know. Prices aren't falling. Inflation isn't crushed. And 401ks look good. But when we get to correction and they're not allowed to short, they're going to look terrible. So all in all, you can make that your own judgment about this. But this is the truth. This is what's really going on. So it's not as described or as being sold to us. Are we doing better? Absolutely. I mean, when you got inflation at 9% for the dope that was in there before, and we're down here at 2.5%, 3%, come on. You got to give Trump credit. That's a hell of a deal. So again, that's the truth. Now, the other thing, also Powell, as I said, he finally said out loud what all of us have known for a long time, that the numbers that we get the first Friday of the month are phony. And he admitted that the revisions are terrible. What happens is the private sector hasn't created any new jobs for roughly a half a year. What are you, nuts? Now, Powell turned around. He described the economy as being zero employment growth. We're not growing. The jobs are terrible. We're not growing at all. And the jobs that we get, like we had that 350,000 jobs, those were $35,000 a year jobs, service jobs, healthcare, terrible. So we're not getting good jobs, full-time jobs with good benefits, not getting those. So the first number they give us every time they give us the job number on Friday, it's a propaganda number. It's a bunch of BS. And then it's finally revised down to the real number. I'll give you an example how they play the game. February, payroll came out, and when it was revised, it wasn't positive. It was minus 92,000. December, originally it was 48,000, revised to a minus 17,000. January, originally 169,000, revised down to 126,000. December, January, December plus January together, 69,000 fewer jobs than they first reported. So they play this game. They put out this big number, and then when nobody's watching, paying attention, revise it down. JOLT, that's the most important one. That showed job openings ticking up in January, but hiring is stuck, staying around 5.3 million. We're just not doing well with hiring. We just aren't. Now, companies are holding on to workers longer, but they're not adding new workers. But they're not telling you that. So again, the biggest thing we got to work out now is, are we going into stagflation? And stagflation, that could be a terrible thing, because once you get into stagflation, you can't get out of it. It's almost impossible to get out. Stagflation is torture. So, and stagflation, remember, is your growth just stops, but your prices just keep on going up and up and up. And that's where we are right now. So the biggest thing, too, that's going on, you've got to stop listening to these buying a dip, buying a dip, buying a dip. What we've learned is headlines do not sustain rallies. Every time they want to pop the market, they come out with a headline. Every time they come out with a headline, right? So the first headline, Iran, right? I think it was March 23rd. Iran, or March 28th, I think it was, or 29th. I'm pretty close to that. They came out and said, well, we're doing good. We're having good negotiations. So what happened? The market, boom, goes up 1,200 points. But then it gave it back. And when it went up 1,200 points, I said to everybody, I said, don't chase this rally. You're going to lose money. You're going to give it all back. Because there's nothing to sustain the rally. Because that rally that we had, after we had that first down day, and then the second day we had that big, big rally, the only way, when you have these short covering rallies, you get first a big down day, then the shorts come in and cover and moves it up. Once the shorts finish covering their short positions, they're out of money. So think about it this way. Let's say you got only 10 traders in the world. They all short Coca-Cola. Goes down. The money they use to short Coca-Cola, they push it down. Now what happens? They find out, uh-oh, we made a mistake. We're trapped. We're losing money. Now they shift and buy Coca-Cola back with the same money. So it went down with the same money. Now it's going back up with the same money. So once they buy it back and they got their shares all back, it stops. The key is to find a key reversal in that short covering rally, which simply means you got to look very carefully. You get that down day, and then the second day goes up. That first down day, okay, that first down day, you want to see the second down day go down and take out that first down day's low. Shove all the sellers out. You also want to see that first down day, as you're trading the second day, you want to see if that first down day, if big volume came in when it hit a slow. If big volume's coming in when it hits slow, then you know institutions are rotating out of their safe place, bonds, investment grade bonds and treasuries, into stocks. But that didn't happen. So the first day, big down day. Second day, boom, it goes up. The second day had to come down and take out that first day's low. And that first day's low, we also had to see more volume coming in on that first day's low. And then that second day, if you don't have new highs and more volume than that first day, it's telling you they're not coming in. So the whole key is to identify, is there new money coming in, institutional money? And on both these rallies we had, March 30th and March 31, using that test, when they hit their low, they didn't see new volume coming in. They didn't see new volume coming in. Nor, the second day when they were trading, they didn't take out the low of the first day. When you don't see that, it's over. It's just totally over. Most people don't understand how short covering rallies work. All the short covering rallies do is give you hope that you can find during that short covering rally a place where maybe the institutions are reversing their position, rotating out of safety and going into risk stocks. But in both cases, March 30 or 29th, I think it was, or March 31, it failed. We didn't have higher volume on the low, and we didn't touch that low the second day. So I hope this helps you. philsgang.com.